We left off last time with this spreadsheet, and so what we're going to do is kind of give you an insight into how it's created and also how we can use it to improve our trading and to make money from the market. But first, what did we learn in the last video? First of all, the markets of all kinds can be and are manipulated, sometimes legally, sometimes illegally. We also learned that specialists sit at the heart of the stock market, have total control over stock prices, are mandated to maintain fair and orderly markets, which is nowhere defined and which gives them large leeway and discretion on how they operate. And they can trade for their own accounts legally and with unrestricted self-interest. We also learned that one specialist firm has 21.8% of the total volume on the NYSE, and there are more than 7 specialist firms operating today, and by our estimates, over 98% of all the volume on the NYSE does go through the specialist's book. And finally, the primary goal of insiders is to merchandise stocks. They start by creating the market in them by setting the bid and ask prices. And this is really, really important. When a broker or anyone who is interested in trading with a specialist comes to their station or requests a quote via electronic means, they receive back a bid and ask price. Now, the specialist can set the bid and ask price in any way they want. If they want the stock to go up, they can set the bid and ask price higher than the previous bid and ask price. If they want the stock to go lower, they can set the bid and ask price lower than the previous quotation. And they don't have to reveal who is behind the bid and ask price, where the majority of the trading happens, where the large blocks are. They don't have to reveal how much is behind the bid, what the depth of the market is for the bid and ask price for their own accounts. So, for example, if they're trading for their own accounts, they don't have to reveal what the depth of their sale or their bid or their ask price is. And so this gives them a tremendous advantage in the markets because they can essentially lower the prices of stocks or raise the prices of stocks at will. Then their merchandising operation consists of understanding buying and selling impulses. And this is really important because if you've been in the market for any amount of time, you know that when stocks go up, if they go up sharply and if they go up dramatically, then there's an impulse to buy stocks because people do not want to feel like they're left out. And that's true for both institutional investors as well as individual investors, because even the institutional investors are under a great deal of pressure to perform well in the market. And if they are missing a very large move in the market or the beginning of what they perceive to be a large move in the market higher, they don't want to be left behind. And they have to report to a board or an executive committee, showing their performance for the past quarter. And if they've missed a major move in the market, they're not going to have their job very long. So they are under the same impulse that everyone else is. They don't want to miss a move in the market, and they'll buy as prices go up. In fact, it's probably one of the only markets that attracts more buyers as prices sharply are raised higher because of that impulse. And the same is true when stocks decline. When stocks decline, especially if they do so very sharply, and this is one of the tools that specialists use in order to accumulate stocks, is that when prices drop very, very sharply, it creates panic. It creates an impulse to sell, and they can manipulate both the news and the prices of the stocks in order to generate the response that they want and elicit the response that they want from investors and institutional traders. So in the same motivations work in both directions. So for example, an institutional investor will look at the stock market, they'll see it dropping sharply. They still have maybe some profit from their previous trades. They want to hold on to those profits, and as the stock that they've invested in is dropping sharply, they will want to exit that trade in order to capture those profits so they can look good on their report for that quarter. If the stock drops sharply and it goes below their buy point, then they're going to have a negative return on that stock for the quarter, and that reflects badly on them. So they will react in the same way as an individual investor will to sharply dropping stock prices, and they will sell. And so that's how, so specialists use that knowledge to both distribute, raise prices sharply if they want to distribute stocks, or drop prices sharply to accumulate stocks, in order to create an active market for the stocks they are in charge of. And all the while they are profiting from their own accounts on an unrestricted basis. Now, if specialists do have 98% of the volume going through the NYSE, then it's reasonable to assume that if we get the data from the NYSE, we can analyze that data to determine not only the accumulation and distribution of stocks made by specialists, but also what their future intent is. And so that's the heart of what we're doing at Tradingology, is by determining their accumulation and distribution plans, we piggyback them and find out exactly what their goals are, and so that we can profit as well from that. You might ask how I learned all of this regarding the specialist. How have I learned about his merchandising operations, how he operates, who he is, and how he uses his insider knowledge in order to raise and lower stock prices? Well, the answer is that I learned it from one of my mentors, Richard Ney. For 6 years, he wrote the Ney Report, a stock market newsletter that counted oil magnate J. Paul Getty among its subscribers. I was also a subscriber, and unfortunately, he passed away in 2004. But luckily for us, he published 3 books: The Wall Street Jungle in 1970, The Wall Street Gang in 1974, and Making It in the Market in 1975. Of the 3, Making It in the Market is probably the most accessible for the average investor. The Wall Street Jungle and The Wall Street Gang contain a great deal of historical information, which I think is extremely important for you to learn. But if you're interested in getting right to the heart of what the specialist system is all about, and how Richard went about describing them and profiting from their movements, Making It in the Market is probably the best one to start with. It's available on Amazon and many used bookstores, I'm sure. Richard was a rare individual. He took a stance against the stock exchange when it was unpopular to do so. He was an investment advisor, registered investment advisor himself. He managed wealthy individuals' portfolios and did extremely well. He gained national attention in June 1962 when Time magazine cover story singled him out as calling the 1962 stock market crash. And since the time, he had successfully called virtually every market turn in the market, including the crash of 1987. He stunned the investment community with the publication of his book, The Wall Street Jungle, his first book in 1970. The individual investor embraced him, and the book became a bestseller. Unfortunately, a lot of his interviews are no longer available. Search online will produce very little of things that he talked about. He did have a course called The Survival Kit for Investors, and I have excerpts from that I'm going to play for you in audio format, where he talks specifically about his system. I owe him a debt of gratitude for the amount of material that he produced for his books and his newsletter and his insights into the New York Stock Exchange system. Let me just play a quick video for you. It gives you an insight into the knowledge that this gentleman had regarding the market.
In that connection, I want to read this to you. Today's Wall Street Journal, the abreast of the market column. The most marvelous newspaper you can get as a contrary indicator, because everything you are told in this will help the stock exchange and contribute to your ruin in the market. Listen to this. Everybody's buying, not just insurance companies or hedge funds. It's everybody, said Thomas Gallagher, managing director of Oppenheimer and Company. I want to ask you, when you read that, and he tells you that everybody's buying, do you for a moment pause to ask who is selling? That's the relevant question. The question you'll never see answered in the Wall Street Journal or on any financial page, because the Wall Street Journal, the New York Times, and the Los Angeles Times have as their proprietary owners the New York banks and the New York Stock Exchange. They own the press and the networks. You'll see, if you read the ownership, go to the library, CD and Company, that's the nominee listed as one of the owners. But it's the nominee of the New York Stock Exchange. They don't put the name in there, of course. They hide that.
Mr. Ney was a great man. So now we're going to go to his excerpt from his audio program. It's down below. You can just click the button to start playing it. Enjoy, and I'll see you on the next video.